All right, now we get to one of my favorite parts of the course, which is the mortgage math examples. Let's go over some examples so that you can better understand how payments on a HELOC are actually calculated. Number one, we're going to go over an exercise on the basic balance calculation. Okay, situation is this, or the problem. There's a borrower that just opened a HELOC with a credit limit of $50,000. They decided to only withdraw $30,000 to renovate their kitchen. The HELOC has an interest rate of 5% per year, calculated monthly. I want you to go ahead and calculate the monthly mortgage interest only payment for the first month, okay? I want you to pause the video right now. I want you to do it. Ready? Okay, now that you've gone ahead and calculated, let's go ahead and see what we need to do to be able to calculate this. The formula is monthly interest equals principal times the annual interest rate divided by 12. So in this case, to be able to solve this equation or this problem, we're going to go ahead and multiply 30,000 times 5%, which is also 0.05, and then divide that by 12 because there's 12 months in a year. So the monthly interest rate would be the division of those 12 months. And this equals $125. So the monthly interest only payment for the first month is going to be $125. And I know this is the first exercise, so you might be a little bit confused, but once you get into the habit, it'll be easier. So remember, the calculation is the loan amount times the interest rate divided by 12. So in this case, the loan amount is not $50,000. That's the limit that the borrower had available to withdraw from, but he only owed $30,000 or she only owed $30,000. Then you're going to multiply that by 5% and divide that by 12, and we get $125. Let's move on to exercise number 2 or problem number 2. Interest fluctuations. Let's calculate interest fluctuations. So the situation is this. We're going to suppose that Jamie had an interest rate on a $40,000 home equity line of credit balance of 4.5%, and it went up to 5.5%. And we want to calculate what the difference in monthly interest payment will be when that rate increases. So Jamie calls us and she wants to know, how do I calculate what my increase in payment will be and how much that increase will reflect on my mortgage statement? So what we're going to do is this. First, we have to calculate whatever the mortgage monthly interest is that they're paying, that Jamie's paying right now, and then what her new payment is going to be. So in order to do that, we're going to take the same $40,000 and we're going to multiply it times 4.5%. Or you can simply put on your calculator 0.045 divided by 12. And that would equal $150. The new monthly interest payment would be 40,000 times 5.5%, which is going to be the new interest rate. And then you're going to divide that by 12, and you're going to get $183.33. When we have $183.33 and we have $150, we can calculate exactly how much that increase in payment is, obviously interest only, okay? And that increase in payment is going to be $33.33. So Jamie will want to know how much it's going to increase by. So you can tell Jamie the payment is going to increase by $33.33. That's simple. Number 3, let's do an exercise now on the repayment impact. So let's say you borrow $25,000 on your home equity line of credit to add a garage to your home. Maybe you need more space, you need whatever it is you need, you may turn it into a home office. If you plan to repay $500 monthly towards the principal, how long will it take to pay off the debt, assuming the interest rate is 6% and does not change? So let's do the calculation. First of all, let's see what the interest only payment is. So we would take 25,000 times 6% and then divide that by 12, and we get $125. The principal payment of $500 minus $125 is $375, which would be how much would be going towards principal. Total months, let's say we have 25,000 divided by 375. The total months it would take to finish paying off the home equity line of credit would be 67 months. So $25,000, how much is owed? $375 is what is going towards principal. So we divide that and we get 67, and that's how many months it will take, or about 5.6 years to repay off the debt. So that was an important calculation that I am sure your borrower is going to ask you, okay? So it's important to understand that. Let's go to number 4. Exercise number 4, full utilization consequence. So let's say Dan fully utilizes their $50,000 line of credit to consolidate debts and pay off all his credit cards. And now he has just one monthly payment. Let's say his interest rate is 7%, and we want to calculate his interest-only payment. So we're going to take $50,000. We're going to multiply it times 7% and divide that by 12, and we're going to get $291.67. So this would be how much the borrower would have to pay now in interest-only payments towards his HELOC. But he would also be able to calculate how much he's saving on his credit cards, which is definitely going to be a better deal than paying credit cards. For exercise number 5, we're going to focus on decreasing the balance and a scenario on that. So let's say the situation is this. You start with a balance of $20,000 on your home equity line of credit with an interest rate of 4%. After making a payment of $1,000 towards the principal, you're going to calculate how much your new monthly interest payment is. So we're going to take the balance, $20,000, and we're going to subtract that by $1,000, which is what you made in monthly payments, which would now be $19,000. The new monthly interest payment would be based off the $19,000, okay? $19,000 times 4% and divided by 12 equals $63.33. So the new monthly interest payment after making the $1,000 principal payment is $63.33.